Thank you for that outstanding introduction, Trent. I really appreciate it. One of the best today. In fact, second best today, because this is my second presentation. So, so we've not got a great deal of election stuff to talk about. So we're just really going to discuss the sort of market in general, I guess. But look, at the end, if you've got any questions for me about anything else, please fire them at me, and if I can answer them, I will. So, as we know, look, the market is in a position of transition, isn't it? We've had this incredible run within the Auckland property market, fueled by record population growth, low interest rates, housing shortage, etc. Really strong local economy. And as a result of that, the banks, the Reserve Bank, and of course the lending banks started to grow increasingly concerned about the risks that there were in the housing market, and the risks that should the housing market have a real turnaround, and we saw some really significant reductions in value. Not only would it impact the housing market, but the economy overall. So as a result of that, the Reserve Bank has introduced rules and regulations, and as a result of that, of course, tightened the amount of credit that is available to purchasers, particularly investors. But at the same time, we've also seen the lending banks tightening their criteria for owner-occupiers and people moving, etc. So the whole dynamic of the market has really been changed by this reduction in the amount of credit which is available to people. And it's had the effect that the Reserve Bank wanted. Of course, we've seen a slowing in the market, particularly in terms of activity, and we've seen those values that had increased by about 85% over the last 5 years plateauing. So really exactly the type of impact that the bank wanted to see. If you took that to one side and you look at the rest of the drivers that have been in play for the last few years, look, most of them, in fact probably all of them, are still there. We're still seeing this surge in population. We've still got low interest rates. The OCR again held today, and the Reserve Bank basically indicating that that's not going to change throughout 2018 into 2019. So, and unfortunately the housing shortage is going to be with us for some time, probably going to get worse. Because not only is it more difficult for house purchasers to borrow money, it's a lot more difficult for developers to borrow money. And we'll talk about all of these sort of things as we head through. So the first of the graphs basically just shows what's happened to the Auckland residential market over the last few years. And the black line is what's happened to median values, and the blue lines are the number of sales in any given quarter. So what you can see is that really from 2011, 2012, as we came out of the global financial crisis, we had this incredible uplift in values, and that was driven by some really strong levels of activity in the market in a situation where the number of listings coming through were fairly short. And then really we see the last 12 months or so, you can see that fall away in sales volumes. Don't worry about that because we've only had 1 month of the current quarter. And at the same time, as activity has reduced, we've seen those prices basically running flat. They'll move around on a quarterly basis, but really they're sort of now running pretty level. Here in the eastern suburbs, look, it's followed very much the same trends. We had some really strong uplift in value from 2012 through to 2016. We were at 1.475 million, the median value in June 16, and it's edged up over the last year, but again, that rate of increase has been much slower than we've seen in previous years, and you can see those quarterly sales volumes just by 450 in June 16, down to 310 this year. So very much in line with the rest of the Auckland market there, albeit that the median values clearly are much higher. And as we're here to talk about the apartments, look, again, they really have followed much the same trend. So what I've done is I've taken out the actual CBD apartment sales there because they obviously depress the values given that they're basically all investor stock. But you can see that again, really from early 2012, we saw the lift in sales activity, aided sort of more latterly through sort of 2015 into 16 by an increase in the amount of new stock being brought to market. And again, we saw this really strong lift in values. Some of that in line with just general increases in the property market, but also I think that those increases in values certainly reflect the fact that we had a lot more higher quality stock coming to market aimed at owner-occupiers as opposed to that investor market. So as I mentioned, this sort of fall away in activity that we've seen has really been as a result of the Reserve Bank tightening that lending criteria, and it was aimed very much at that investor market. And you can see what's happened to their share of new mortgage lending. The new rules and regulations were brought in sort of the middle of 2016, actually came into operation in October of last year, but the banks were told to start throttling back prior to that. So you can see that at the peak of the market there in sort of early 2016, of all of the new mortgage lending that was taking place on a monthly basis, about 36-37% of it was to investors. And you can see that as a result of those new restrictions, that's come back to about the low 20%. So that's had a number of effects, as we've seen in those earlier slides. Clearly activity slowing as investors have found it more difficult to transact in the market. But what it has done, of course, is it's opened the door somewhat for first-time buyers, because all of a sudden they're not competing at that bottom end of the market with as many investors. And it's also shifted a larger proportion of sales to people who are transacting within the market, selling their own house, buying somewhere new to live. And you can see those figures there. So investors' share of the of mortgage lending, as we see, has fallen from 35 to 22% over the last year. First-time buyers, they're up from 11% to 15%. But look, it's people who are transacting in the market, moving around, have taken the larger chunk, up from 53 to 62%. And that really reflects the fact that, as I mentioned earlier, when people are looking to borrow for a mortgage, the banks have become increasingly more conservative over the last year, making you jump through a lot more hoops in order to reach their lending criteria. But what they do like, of course, is they like low risk lendings, and the people who are the lowest risk are the people who are able to bring more equity to the purchase. So certainly for those people who are looking to downsize, release some equity from their homes, very much that puts them in the driver's seat. And you can see that reflected not only in that sort of share of mortgage spending, but also in the strata of the market in which they are active. And you can see that here. So these are house sales for the local suburbs. And you can see that sort of in the year to June 2016, 28% of sales were in the $0 to $1 million. Not many at $0, I would imagine, but 26% $1 million to $1.5 million, and just 46% $1.5 million and above. Move on a year and we've had that reduction in sales volumes, remember. But look, the lower end of the market has fallen away 21% because there are fewer investors in the market. That middle section has remained pretty unchanged. But look, it's the upper end of the market which has proved to be the most resilient. And again, that reflects the fact that the people buying at that end of the market are generally bringing more equity to it, and that's because they're buying and selling at that upper end of the market. And that, of course, plays into the hands of downsizers, in particular people who have now developed the good sense to tell them that they don't want to spend their weekends doing this. What they do want to spend their weekends doing is enjoying the amenities of the local area, or getting out and travelling and locking and leaving the safe apartment behind them, and have somebody else to look after all the maintenance concerns, etc. So seeing a big trend in this. I, of course, was well ahead of the trend. I bought an apartment 3 years ago, and I will tell you, it's marvellous living, it really is. But you can see that the people looking to sort of transact in this part of the market, certainly in the prime position, given that they reflect a much lower risk for the banks, etc. So we've seen what's happened to the market as a result of the tighter credit conditions. But as I mentioned, if you look at the real drivers of the market, which have been in play for the last few years and have driven this huge increase in values, they're all pretty much still in play. And so what we're going to see, of course, is pressure building as a result of that, held in check by the lending criteria of the banks. So as I mentioned, low interest rates are going to be with us lower for longer. Ever since the GFC finished and the banks all slashed interest rates and we had quantitative easing, money being thrown at everybody, we've seen assets increasing in value. And every year subsequent to that was going to be the year when we started to revert back to the longer term norms. The United States in 2015, they were going to see 4 increases in their OCR rate. In 2016, we were going to see 4 increases. In 2017, we were going to see 4 increases. Well, over those 3 years, we've actually only seen 3 in total. And the one which was supposed to happen in September, of course, this year has been kicked down the road again. And if we see another increase in the States, it won't be until December. So everywhere this reversion to what we've accepted as the long-term norm for interest rates has been delayed. And I would suggest that while we will see an upward movement in those rates over the next couple of years, probably, it's really going to be incremental. And if you read what the Reserve Bank are saying, they're saying that the neutral interest rate used to be sitting at around about 6.5%. So that was the rate that they thought wasn't stimulating the markets, but wasn't holding them back either. They now think that neutral rate is around about 4.5%. So their view is that we've actually had a paradigm shift, and that we're not going to have to see the really high interest rates that we've seen at some times in the past. And of course, part of that is the fact that they're using other tools now to control the housing market, like loan-to-value ratios, etc. The population boom, well, that's all about migration, isn't it? And this is what's happened to migration through New Zealand over the last period from about 1990. And you can see at times when the New Zealand economy is performing poorly and the Australian economy is performing well, we have more people leaving than we have arriving. But that's not been the case since about early 2013. The New Zealand economy has been booming. It's been one of the strongest performing in the Western world. The Australian economy, post the mining surge there, has been more sluggish. We've had all of these global concerns, the Trump election in the States, Brexit, terrorism in Europe and North Africa and the Middle East, the North Korean situation, which is escalating all the time. The rest of the world looks a really scary place, and if you're a Kiwi living abroad, you might be looking around and saying, hey, now's a really good time to head back to New Zealand. There's plenty of jobs being created by a strong economy. It's much safer than being here in London or Paris. We might just take our families home. And so we've seen this big surge in migration. So 72,000 more people living in New Zealand this year than there were this time last year. And about 50 to 60% of that increase in population is having to be housed here in Auckland. Hardly surprising, therefore, that we've seen this huge pressure on the housing market and the housing stock. Of course, that is going to continue. A lot of talk, of course, from Winston and from the Labour Party about how they're going to slash migration if they come to power. But as I mentioned, look, a lot of this inward movement of people is Kiwis coming back home. They've got their New Zealand passports. They don't need anybody to give them permission to come back. So certainly that pressure will remain, and both Labour and Winston will find if they slash migration that all of a sudden they'll have even more trouble finding people with the skill sets to build houses that they want to build, 150,000 houses they want to build themselves. Well, good luck finding a plumber, good luck finding an electrician if you've slashed migration. So some of their policies just don't completely add up. Oh, I've turned that off, have I? There we go. And if we look at those projections for Auckland, look, we've currently got about 1.6 million people over the next 25 years, up to 1 million more people coming into the city. So you think it's crowded now. Imagine what it's going to be like in 25 years. We've got 505,000 homes at the present moment in time. If we're going to house all these additional people, we need another, we're going to have to lift that by 400,000 homes. That's about 16,000 homes per annum. Over that 25 years. And we've seen a big increase in the number of building consents that are coming through, but despite that, look, we're sitting at about 10,000 building consents over the last 12 months. Two things to notice there. One, the rate of increase is really tapering off, and that reflects the fact that there's huge constraints on the building sector. The other thing is that although building consents are running at just over 10,000, the latest figures from the council of properties that have actually been completed is nearer 7,000. So we're probably not even building as many houses as we thought we were. So that housing shortage isn't getting any better, it's just getting worse, and that pressure is building in the background. And look at the problems that you have in meeting that requirement. The capacity constraints within the development sector. So we've spoken about that again with the skilled workforce that you require to build that, the materials that you need, and the cost of those increasing on the basis that basically there's a monopoly here on building costs in New Zealand. And then, as I mentioned earlier on, the restrictions on bank funding, not only on buyers but certainly on developers, a lot more difficult to get your funding together to put together an apartment complex at the present moment in time. Here in the local area, look, everywhere else in Auckland, we've had the unitary plan has come in, and basically everywhere is going to see more intensive development. Everywhere except the local area, really, and so you can see that this is what's happened. Completed apartments over the last couple of years. Basically, there's been a few in Parnell, but outside of Stonefields in this sort of region, there's been nothing completed. And you can see marketing in Mission Bay. I think there's these Outlook, and then you've got Horizon next door, and I think that's pretty much it. And the reason for that is, as I mentioned, that the Auckland plan for this area just doesn't allow intensive development. All of this yellow stuff is basically standalone housing. Here you can go up to 2 stories. So 5 stories and above is the sort of darky orange. So we're here in this little strip where it's permitted. Here, which I think is already been developed by Ryman's. And then there's, and it's not. And then there's a little bit around there at Mission Bay. And then you have to go to St Heliers. So look, the opportunities to bring apartments to the market within the local area is restricted by the fact that the local residents were very good at resisting changes to the zoning during the public consultation. So well done, or maybe not well done. Look. The key value drivers when you're looking at apartment living, what people are looking for, as we mentioned earlier on, is a change from that day-to-day maintenance, etc., that they have to have. And here, what we've already seen, there's going to be a limited supply of apartments, and certainly high-quality apartments to this area. And that is despite the fact that, look, it ticks so many of the boxes, doesn't it, for what people are looking for when they're looking to move to a more relaxed lifestyle. So we've got easy access to the CBD, proximity to the beaches, retail amenity is several centimetres away, food and beverage choices, excellent schooling in the area, and public transport options. And this sort of local environs here certainly encapsulate a lot of that. And so it's hardly surprising that when you look at what's happened to the apartment market within the local suburbs, what we can see is that we haven't seen this plateauing in values that we've seen across the wider market. Those have continued to trend up, reflecting the fact that there's a limited supply and the supply tends to be of a higher quality. So that's been good. We have seen a reduction in sales volumes, but again, you wouldn't expect to see too many sales in an environment where there's not a great deal of property being brought to market, but in some ways sort of bucking the trend that we've seen across the wider market. And that sort of comes back to what Trent was saying earlier on, that they haven't seen the slowdown in inquiry that perhaps we've seen in other parts of town. And this was the part where I was going to tell you everything you needed to know about the property market post-election. I don't know. We always talk about New Zealand having great political stability, which was one of the things that draws people to New Zealand. So they might be looking at us in a different light and going, what the hell are these people doing? They've had an election, but they haven't got a government, and they could not have a government for some time yet. So I am of an inquisitive mind, and I wondered to myself, I wonder if there are any other sort of leading Western societies where they've had to go without a government for any length of time. So I spent a day and a half of my employer's time surfing Google, and I found out that after I think it was the 2011 or maybe 2012 election in Belgium, where they too have a proportional representation system, all their parties were really close together, and so they had a situation where they didn't have a government while they negotiated coalitions for 541 days. So I'm not sure that the Governor General is going to give even Winston 541 days to sort it out, but hey, you need to bear in mind that this could drag on for a little while. Interesting to note that the Belgian economy performed quite well during that time, so maybe the government was just getting in the way. So anyway, I think Rachel's trying to organise a bit of a get-together for us once we do have a government in place, and perhaps we can have a bit of a chat, a more informed chat about how we see things playing out. But look, I think most of the major concerns that property investors had leading up to the election, which was basically a lot of the tax proposals that Labour said we're going to put through to their faceless committee, has been kicked down the road until 2020 plus. So the capital gains tax, the land tax, the asset wealth tax, etc., are not going to be a concern over the next 2 to 3 years. So I think that on that basis alone, we might find that. Investors might be a little bit keener to re-enter the market. I was reading something from the BNZ yesterday, and they think that the Reserve Bank may be in a position round about the middle of next year where they feel comfortable enough with the fact that the market has run flat for a while to start easing back those LVR restrictions. So we're at 40% at the moment. I would imagine they'll do it in 5% chunks, so that the market doesn't get away from them. They retain some control, but just free it up a little bit. So how do we see things panning out? Well, look, this is what's happened to Auckland housing values from about the end of 2080, and you can see that there is a general sort of trend that happens. You get a period where you get a lift in values, and then there's normally something that happens abroad, like the stock market crash or the GFC, that causes the market to pause, and you have a period where in Auckland really things just tend to run flat. We don't tend, fortunately, to see big downturns in values like you see in some other cities around the world, and then things take off again, and then they flatten off. And so post GFC, of course, we've seen an unprecedented run in those values, and now we're heading into a period where things flatten off. And look, that's healthy. That's healthy for the housing market, because this sort of increase was unsustainable, right? People's wages aren't going up, especially if you're a research analyst for Bayleys, And so fewer and fewer people be able to transact in the market where things have just become unaffordable. So if we get a period where things run flat, it's really no concern. It would only be a concern if we saw a reduction in values, and I don't think we'll see anything significant there, because I think the Reserve Bank has acted early enough to stop that. I think I've got time for one question.
I think everybody in the room has sort of probably had a property some decades ago, and if you were starting off from scratch, it was always a bit of a problem, right? Yeah, we had a problem and whatever. Anyway, but at 15% being first home buyers, how realistic is that? Is that appropriate? I mean, the rest of us are not in that area, right? Mm-hmm. The rest of the people who own all these houses are not in that area now, but would not, from a government perspective, say, hey, 15% are new houses, isn't that wonderful, rather than woe is us?
Well, that's right. I think that that's still a pretty large number coming through, but I think what they look at is that overall home ownership statistic, and New Zealand used to have home ownership sitting at around about 80%, and it's now at somewhere between 60 and 65%, and a bit lower than that in Auckland. So I think that's what's concerning them, that they feel that more and more people are being just held out of the market, and not all of those are renting because they want to. I think a lot of people are renting because they want to, because it gives them a lot more flexibility. But I think that home ownership has always been the dream in countries like New Zealand, Australia, and Britain, and they're just concerned that more people are getting locked out of that.
I just wanted to understand, you've got 16,000 houses needed a year, or dwellings needed a year,
yes.
And there's 10,000 consent. So is it consent, like an apartment building with 300 apartments? Is
Would
that
be
one
300.
consent?
No, that would be 300.
With the US interest rates, were they moving from like 0.5% to 1%?
They've moved from about I think they were just about zero. They were 0 to 0.2, I think, for a long time post GFC, and they're now sitting at about 0.75%. So
that'd be nice.
And the other question, immigration.
Yeah.
Obviously, those are net numbers. So
yes.
You hear it around the wine cooler. Water cooler, you should say. Not the wine cooler. Is there a big shift in people staying and not leaving? Is that what's skewing the numbers, or is it actually just more people flowing in?
We have had more people coming in, but yeah, you're right. What normally causes those big dips is people who leave, and there are fewer people leaving. And fewer people will leave until such time as the Australian economy fires up again. Although clearly, the relationship between Australia and New Zealand as a nice place for New Zealanders to go and live has changed a little bit recently. They're being mean, apparently, to Kiwis, and Jacinda's going to be mean to them as well. So we'll see.
Just finally, Ian, what constituted an investor on the investor slide? Was it just anyone that owned more than one property, or?
Yeah, I think that's pretty well. No, you have to you have to inform the bank. Do you not? I think the purpose of your house purchase, so they know that. So I think that they would not include like holiday homes in that, despite the fact that probably people make more from Airbnb-ing their batches than they do for renting out their properties on a weekly basis.
All right. Thank you very much.
Thanks, Ian.
No problem at all.